My name is Stephan. I'm one of the founding partners of AQVC. We're gonna talk a lot about AQVC actually today in this edition because we got a lot of requests of questions. Our last webinars, always the highlight of it were the questions when the audience could ask all the questions. And since we do this live, we started to collect a lot of questions up front, and we're trying to talk through those questions in the content. I was a founder and entrepreneur before, built a couple of tech startups that I successfully sold, started to invest as an angel, and together with my partners realized angel investing doesn't scale, so we wanted to have for our own a semi-liquid product to invest in more scale into venture capital and have it more easy, more flexible. And so that's how AQVC was born almost 3 years ago. And Marius is one of my partners who built this together with me and our other partners, Oliver and Marcus. So Marius, maybe very quickly about you.
Thank you, Stephan. Hello, everyone. My name is Marius, also one of the founding partners of AQVC. I am an educated lawyer, but left this environment quite fast, or faster than others, I think, to help build up a startup company built in 2012. And parallel to building more than a dozen companies, we started raising and investing and managing venture capital fund vintages over a decade, with total of, I think, plus 80 investments. And given this background, I'm in charge of fund structuring and fundraising, as well as investor relations at AQVC. And yeah, happy to be able to give you a bit more insights to our innovative fund of VC fund structure today.
Perfect. Thanks, Marius. And anybody listening in and who wants to ask any questions, the chat, we actively monitor and read the chat. So please use the chat also if there are any technical issues. It's actually the first time we're using Riverside. Normally we are doing this in Zoom, but we wanted to try this. So please let us know in the chat if there are any issues around this. But it is also recorded. And so you can also watch the recording later if you have to drop off. So without further ado, let's get started. So quickly the agenda for today's webinar. I'm going to tell you a little bit about the current market opportunities that we see in venture capital for fund of funds, and why we do think that fund of funds, even though there are fund of funds out there, even for venture capital, there is a big market opportunity right now to build an innovative structure and to also rethink how fund of funds and investing in venture capital is really done. Since one of our core vision and drivers is to democratize the asset class. Yeah, and I think there we do see that venture capital as an asset class is slowly maturing. It's maturing out of a cottage industry. And so there will be also more innovation in how people are allocating to the asset class. And I think this is our overarching goal, where we see an under allocation across Europe and across a lot of ecosystems to innovation, to venture capital. And we believe it's fundamentally important to back technologies, to back daring entrepreneurs. And in our journey, we were always grateful to have access to great VC funds as well as angels. But there are not enough allocators in this world. And a lot of people do want to allocate, but they are not perfect ways to allocate. So I think that's what Marius then also will touch in the second part, where we talk about our innovative fund of funds structure and solution, how our flagship, AQVC's flagship fund of fund, can benefit investors and is actually an innovation in this market to democratize the asset class. And last but not least, we open it up for questions. If you do have questions in the meantime, always reach out, always stop us. I know Marius will stop me if I don't explain anything correctly, and I will stop him. So let's try to make this as interactive as possible. And let's kick it off. So one core thing that we have observed, and is really driving us, and we've been in this ecosystem for 12, 15 years, yeah, and so we've really seen the .com crash live, how it was as founders, as VCs, and especially before 2015. So this time, it was very clear how venture capital overall in the ecosystem was structured, right? So you had a very clear structure of how funds are behaving, and they were not really crossing over into each other's territory. So you had very few angels, you had a few traditional VC funds, a few European VC funds that were only emerging, that are now big household names, and you had then obviously growth, PE, and public markets. So all of them were playing in their own focused categories, but then in the last 10 years almost, so after 2015, or around 2015, it has changed. So some of these traditional VC funds, they just got very, very large. So they were playing an AUM game. They were setting up new and more funds. Yeah. So some of the managers were then playing an early stage game across Europe, across emerging markets, etc. You had a lot of US funds starting to enter Europe. Yeah. So competition there was heavily increasing. And obviously you had more and more crossover funds from the public markets, which increased the velocity of fundraising for founders. And that meant that a lot of startups were funded that may have or shouldn't have been funded as heavy as they had been. Yeah, and so this resulted in, I'm sure most of you have watched We Crashed, and some of the now pop culture media versions, but there are, in quick commerce, in e-scooters, there are a lot of great businesses that emerged. However, these are not necessarily tech businesses. Yeah, and I think that's a very important distinguishing fact. We are not bashing, or we don't want to say anything negative about these businesses and funds. I think they're great businesses. We love them as consumers, but they just don't deserve a tech multiple in a lot of these cases. And we saw that a lot of solo GPs, micro funds, and conservative blue chips funds were emerging, focusing on this. And so I think that, we just got a question actually. There's an alternative live stream on YouTube that Mark just shared if you are having issues in viewing the presentation. These new funds, they still continue to focus on great innovation. I think that's very important that these more focused strategies versus these larger generalists, they actually have access to the best emerging technologies. And that's something that we are now seeing as a big opportunity today. Yeah, so now we live in a world that has corrected, the market correction has happened, and we do see that there's a big opportunity in accessing small, hard to select emerging managers that are very fragmented. So the workload required to select these managers for much smaller ticket sizes is actually quite high. And if you do this out of a family office, out of, a larger allocator, then it obviously takes more time. So instead of allocating 10 million to a single fund, you want to allocate 1 million to 10 funds or more. And that means obviously you need to look at all these funds, do a lot of due diligence, and then consolidate the work, right? The relation with these fund managers continues for the fund duration. And this is obviously a very, very long time frame. We're still talking about 10-year, 15-year investment horizons here. And on the other hand, we have established blue chip funds that remained conservative in their fund size. They have grown over the years in fund size, obviously, but they are small relative to their market size, and they've just become big brands to attract the best founders. And I think this is another big opportunity to make this more accessible to investors, because normally these funds require very large ticket sizes and are definitely not accessible to any small or even emerging family office, right? That is new to the VC ecosystem. So we do see that these managers, especially the emerging funds and developing funds, have traditionally been outperforming. So at the end, we always also talk about performance. And this is data from the European Investment Fund, where we see for fully built vintages from 2004 to 2016 that the top decile performance of these vintages almost every year, around 70% is made up of emerging or developing funds. Emerging funds are funds 1, and developing funds are funds 2 and 3. So these are really funds. That means that they have track record, obviously, but they're very hard to select. And if you talk to these fund managers, they very often are struggling to fundraise, and also investors are sometimes struggling to commit to these funds. So again, this is where we are specializing on. So continuing what we see obviously right now is a great time to invest in venture. I mentioned not only the shift in funds that we have seen, but it's also after market correction. So now we are back to having access to great talent. So a lot of people are still looking for jobs in VC. Big tech has corrected. There are a lot of people now looking for jobs, people starting new companies, and these companies are very frugal. So looking to deploy their funds into the right solving the right problems and finding product market fit. And this is what obviously usually breeds the best vintages, at least historically. And so a lot of people share this, that historically these vintages that are created right now outperform by over 7% on average. Venture isn't an averages business, so you always have outliers in there. And I think that in 10 years time, we'll look back to now 2023, 2024, and actually see that these will be the best years of venture historically at that point in time. Another big topic that we have observed is that venture is a global opportunity. So historically, a lot of fund of funds have focused on access to the US. So we are obviously in Germany, we are European. A lot of European family offices, they don't have access to the US, so they invested into a fund of fund that gave them access to Silicon Valley. That was great the last 10, 20 years. However, venture overall is a global phenomenon. The knowledge of building startups, being an entrepreneur is being democratized. Yeah. And so everywhere where we see unicorns in an ecosystem, so that may be in Munich, in Berlin, in London, in Paris, in Warsaw, there are 20, 30 new startups coming up with much more experienced founders. And this obviously also attracts investors. And these investors, especially in the earlier stages, they need to have boots on the ground. Therefore, it's a fragmented market with local investors in all of these ecosystems. Now, talking about the opportunity at early stage, so obviously investing in early stage is the most risky. Yeah, if you are an angel investor like what we have been doing, or what Marius has been doing, incubating companies, or really investing at the earliest stages, you will have some companies that will not make it. That's very clear. And you will have some zombies that will not, you don't know where they will go, but they will take a lot of years to either be, acquired in a fire sale or an acqui-hire or to shut down. And this is fine, right? This is the part of venture, of creation, of innovation. But that means also you need diversification in order to tap into these best opportunities. And that's why diversification, if you do it directly, is very, very hard to do. You need to then really build up your own investment team. You need to have boots on the ground, etc. So the best way in our way to get diversification, in our point of view, at the early stages is by investing through a fund of fund that will cover from pre-seed to Series A, Series B. And then you can invest directly as a family office if you have that capability at a Series B, Series C, where still a lot of upside can happen. Now, we see ourselves as the bridge between established and emerging funds globally. And I think this is also very unique because there are very, very few fund of funds, we actually don't know any, that in one vehicle, in one structure, allow you to access established VC funds, bigger brands that are well known, as well as emerging managers that will be the big brands of tomorrow. And I think this is a cycle. People don't understand historically that emerging managers mature into an established firm, and sometimes also established firms don't want to grow too big and they might shut down at some point. Doesn't mean the funds will be bad, but also some of these funds may not continue, because some fund managers may retire, and things like looking at the past performance is not the predictor of future performance, obviously. And so keeping that fresh, always looking at which emerging managers will be the next brands of tomorrow is something that is very, very important in our point of view. And that makes us unique as an LP. And we believe due to our team, due to our knowledge and track record as fund of fund investors, but also as entrepreneurs, we have not just the best access, but also the best sort of gut feeling for selection. We also have a big DNA for good, and this will be the perfect segue to Marius, because our democratization vision, we want to make it more easily accessible, and that doesn't mean retail. So it's very important to understand we're still a product for professional investors only. So it is not a retail product, and the retail vision is something that is much, much later down the line. But even in the professional realm, in the wealth realm, there are so many family offices, so many businesses that have no allocation to venture capital or access to innovation. And I think this is what we want to change. Secondly, a big plus why VC funds want to partner with us is because we are a very reliable source of capital because of our long-term nature. We are a permanent capital structure. We are an evergreen. Marius will tell more about that. But that means we don't have to rebalance, for example. We will continue to back the managers as long as they continue to perform. And last but not least, we are tech-enabled. So we don't talk about this today a lot, but actually we've built AQVC from the ground up to be tech-driven first. And I think this is also a big change in the industry, where historically deals were done very intransparent, were done on a sort of tit for tat, on a golf course level, very little diversity in venture capital overall. And we want to change this by using technology as the backbone, as really putting our investment team, our gut feeling, our investment experience on steroids. Yeah, so we'll do a webinar on this hopefully in the near future and tell you more about our unique discovery platform. But now let's talk about our evergreen structure, and this is the perfect segue to you, Marius.
Thank you, Stephan. Everything you leads to some hurdles and efforts had to take in order to create a structure that fits all this and prepares us and our investors to be able to invest into the future in the best possible way. So the AQVC structure, and maybe we also already skip to the next slide, Stephan, as a short overview, is tailored to the needs of investors. So we learned in more than a decade as investors in startups, founders already, company builders and VC funds, what the needs and what the pain points are. Our focus clientele are today mainly high net worth individuals and family offices, but also institutions, at least further down the road. So we needed to build a product which serves in best case all of these segments. We could crystallize, I would say, 4 key problems why VC as an asset class is mostly underrepresented and sometimes even hardly cultivated in family offices or other portfolios, which are risk, intransparency, not enough access, I would say, and illiquidity. And we try to tackle these problems, reflect them in our fund structure, and by that lower the potential hurdles to invest or invest more in the asset class venture capital. In general, you can see on the right side of the page, investors invest into AQVC via a German-based non-listed stock company, which is kind of unique, I think, today. We know no other fund in Germany structured as a stock company, as a German AG. And you invest by purchasing stocks, as simple as it is. In German governance and tax compliance topics follow the German capital market laws by that and are thereby covered. Next slide, please. Let's talk about risk as kind of the first of the big 4 hairy hurdles. Depending on VC maturity levels, both experience levels, a lower and a higher VC maturity, are interested in risk reducing, obviously. With a lower maturity, you should enter this asset class via a managed and diversified product, and with a higher maturity level, maybe already existing direct or fund investments with a fund of fund, and by this complement your portfolio. In both scenarios, the intention is and as a fund of fund, we are by nature, of course, a highly diversified product. The target portfolio today consists of the target portfolio of AQVC is more than 50 fund managers in the future, and today consists already of 9 and about 80 underlying startups already. Out of a risk perspective, this lowers the potential loss, obviously, to under 1% statistically, to a regular VC fund investment with 20 to 30% and a direct investment with about 70% risk of a total loss. This is a way better risk return ratio.
So Mari, maybe quickly jumping in here as a question, or maybe making it sure for everybody. We started with AQVC investing pretty much a year ago, so beginning of 2022. and we have this, like, we continuously invest. So we invest in about 2 funds per quarter, and we will continue to do this for infinity, technically, right, with the evergreen. And that means if we have these 50 manager relations, all of these funds usually come back every 2 to 3 years, maybe every 4 years, to raise their next fund. So that means, obviously, when we continue to back these managers, we'll build up a portfolio of hundreds of active funds. Some of them may be in year 12, some of them may be in year 1, but that gives investors a very nice diversification that's not over diversified with 50 managers. So it's not, a huge portfolio, but obviously reducing the risk significantly. And this, I think, is the main point here.
Yeah, that's totally true, and especially the blind pool risk, which kind of leads to the next slide, Stephan. It's already today reduced, right? Because with every investment we take, this reduces the blind pool risk a bit, and we think this is kind of the second big problem why not more people invest into venture capital yet. In transparency makes it difficult for kind of every asset class, right? So the more people understand about the topic, or about any topic, the more likely they will invest. Furthermore, we see experienced a damper in regards to trust within the last 2 years, and therefore it will be essential in the future to rebuild this trust. And transparency is, in our opinion, one of the key factors, probably. So as an evergreen structure, not only accessible and ready when you are, but we lower the blind pool risk with every single investment. As mentioned today, already 9 funds and underlying startups, 80 plus and counting. Every investor who joins our fund of fund today knows what he or she is buying. This gives every investor not only immediate diversification, but also kind of haptic assets. And yeah, you kind of see what is in there already, and maybe the whole thing goes, and not only kind of a vision of the future that could come. Also different maybe to closed fund of fund structures. This is kind of very important in regards to the evergreen structure. And this provides also access to already closed vintages. So by joining AQVC, for example, today, you get exposure to an already closed vintage in 2020 or 2021, and even orders, as we are already purchasing secondaries as well. So this is kind of unique, and thereby the risk return ratio is immensely leveraged.
Yeah, Mario, I think one thing that we have observed, obviously, is that if a fund is closed, then it's obviously you can do a secondary if there's anything on the market, but doing a secondary transaction in an existing fund that is closed is super difficult, right? That is a long process. It's usually costly. And there needs to be a buyer and a seller that need to agree on a price, etc. Right? So I think with our structure as a baseline product, right, we always look at it from an allocation mix when we talk to our investors. Most of them are European family offices. They always look at venture as a whole of a whole range of potential investments. And there we've come to the conclusion, analyzing the market and analyzing the data over the last 30 years, is that a fund of fund gives you this baseline exposure. And so it's nice with our sort of rolling closes that investors can move in at any point in time. Yes, there's a higher price, so you obviously are paying for the current market value or the net asset value of the assets that when you're investing at that point in time. But you have a much clearer portfolio, obviously. And I think this is super unique in the market, where we have not found any other product that offers this kind of access and transparency for early stage venture capital.
Yes, exactly. Next slide, please. So a bit more deep dive to the evergreen structure, which is very important. And in order to keep the trust level high, which is, as said, necessary to in parts even rebuild in the future, we actively communicate with investors. This is not necessarily part of a structure or the company structure, but it's important to mention, I think, because as you will experience it differently in other funds. Investor relations suffered within the last decade in the VC environment due to often great developments, at least with we believe that transparent communication is key to a sustainable relationship with investors, and of course, as well with our portfolio funds. the investor relations and communication are key for us, because since evergreen fund managers have a longer relationship with the stakeholders, the alignment of interests here, right? So in order to create or build that trust level, we need to actively communicate with everyone of our stakeholders. Generating consistent returns and not only a one-time exit is also a reason and leads to a shared interest in. It makes it possible also to foster strong relationships and more collaborative approach, and again is essential for building the trust. Of course, being evergreen brings a lot of more financial advantages as well, and I don't want to dive too deep into that. Come back to me or Stephan anytime afterwards, but compounding effects, time savings for reallocation are just to mention some of them are also very interesting in regards to this evergreen structure, of course.
Yeah, and I think, Marius, the point that I always find very interesting, and we talked a lot of it with our VC funds that we have invested in, is that the typical LP setup of funds is also changing, yeah, due to the sort of general democratization of private assets, right? This is a general market trend. It's a mega trend also. It means that traditionally the VC funds, right, which I talked about in the introduction, they had very few LPs. They had maybe 10, 20, 30 very large LPs, so big endowments, big insurance companies writing at least minimum tickets of 10 million or more. Yeah. And this has obviously now is also shifting, yeah, with a lot of emerging managers that have, you know, a very, very good track record setting up funds 2, funds 3, and then suddenly they have 100, 150 LPs, 200 LPs. So investor relations also becomes an actual, you know, workload, right? When you only have 10 LPs, it's a much easier relationshiping that you have to do versus if you have 100. Yeah, that's 10 times the questions you will get, and so
yeah,
I think
and
this is
also not only the amount, but also the mindset of the investors, right?
Yes.
So managing 10 institutionals is way different than managing 100 high net worth individuals or families even.
Yes, exactly. And this is why we have focused on building a tech first, yeah, so that we are focused on, we understand the relationship, we understand the human nature of face-to-face meetings and the importance of that. And that I think is very important for each GP to understand that you need to, we are in a service industry, right? Yes, we are an investment product, but we're giving a service to our investors. And so we need to be there for them when they have these questions, but we also need to be scalable. And so this is the technology that comes in, where the venture ecosystem overall has not seen innovation in its processes in the last 30 years almost, yeah. And this is where we really want to be a tech-enabled asset manager and drive innovation and adoption of technology in the ecosystem by making it easier for fund managers to engage with LPs.
Yeah, exactly. This leads also to our next slide, Stephan, and we need to talk about access or the lack of, at least, and insights maybe. Talked about it already, selection and accessing, depending if we want to invest into established managers or emergings. So this is kind of the third hurdle where people are not investing, right? So many of the top tier funds are oversubscribed, obviously, and often ask for a minimum ticket that is not affordable, or at least destroys a high net worth individuals or families diversification approach. And when you join a structure like a fund of fund, like AQVC, that combines forces and gives you access to a multi-million portfolio with a ticket size starting down at 6 digits, often. This is often the only way to enter even this asset class in a reasonable way. And Stephan already also talked about this interesting fact that around 70%, plus 70% of the top decile VC funds are emerging or developing managers. And this shows that there are great performing accessible funds out there, but not only the top decile, but also the bottom half is shaped by emerging managers. So it's crucial to be able to find, evaluate, and access the right fund managers. And as a fund of fund, we help with a kind of unique market overview, and you can take or we can take you by the hand and you can learn thereby how to pick and what to look at. Last but not least, liquidity or illiquidity as one of the big hurdles, especially in today's market environments. It's a high hurdle when entering or extending within this asset class. A typical VC fund structure is a limited partnership, right? So it's hard to exit before the liquidity of the fund after the end of the fund period, the official end of the fund period, which is mostly 10 to 14 years. So not only that you invest into a blind pool, you are stuck for many, many years. We think it's important to at least provide a so-called semi-liquidity. So hear me now double kind of, sorry. Perfect, thanks. We think it's important to at least provide a so-called semi-liquidity, and different to other funds, investors do not invest by signing an LPA, but instead through this, as mentioned, much simpler process of acquiring a stock. So this allows us to offer a very important security aspect, which is a way higher liquidity than in a closed and limited partnership. And as you can see it on this slide already, there are many ways to exit the VC fund structure in case there's a need or a wish to do so. So AQVC implemented we call it purchase program, so twice a year in this year, and starting from next year, it will be 4 times a year. 20% of every capital raised for our fund of fund can be used for secondaries of existing shareholders at the actual share price based on the current net asset value, obviously. We, as managers, committed 50% of the management carry as a reserve for rebuying stocks. Furthermore, in case of a supply overhang, external liquidity providers are in place to buy the remaining shares. So we work with several parties there and want to make sure that there's always liquidity available if someone needs to or wants to exit. Of course, this is a more soft factor, but we are a stock company. So as a holder of stocks or shares in a stock company, you are at any time able to sell your shares on your own. AQVC will, of course, always help making matches with potential buyers. And last but not least, this is more, I would say, a long-term vision, but we plan to be at one time listed on a stock exchange. So we are working on that, and there needs to flood some water down the river for sure. But we are sure that venture capital will go through development of democratization and access, and we want to be in place to give access to a wider segment of allocators in the future, and be ready for that.
And I mean, this is a general market trend, right? I think there, if you are a little bit in the industry of structuring, then there are LTIFs, there are different structures in private equity, listed private equity with Partners Group and other players in the market that offer already these products. But I think it's early days still in this space, and none of these players yet, like we are, is 100% focused on early stage venture capital and early growth, right? A lot of them are just mixed, very large asset managers that do everything and nothing. And I think the strength comes from specialization and focus. And I do think that, like we see with ETFs, for example, over the last 20 years, how the boom of ETFs made kind of managed funds for public equities a little bit more difficult and very competitive, easily accessible, etc. for a lot of people. The same will be true for private markets, where the bridge between the public markets and the private markets, they will sort of converge, and you will have different products, whether it will be our stock, right? Whether the AQVC stock will be the Berkshire Hathaway of venture capital of the future. We don't know. Yeah, I think but
we have high ambitions.
We have high ambitions for sure. But it doesn't matter, right? At the end of the day, even today, it's a fantastic investment product, and we've put in the structure so we are flexible in whatever the future holds, and we definitely want to be on the forefront of this. And I think this is, when you look at how a lot of the big players in the alternative space have emerged, this is how a lot of them started, right? It's small, it's focused, it's with a very strong conviction, and I think a lot of that is driven and comes from our entrepreneurial DNA. And this, I think, makes us also very different, that we are not not just fund managers. Yes, we are also fund managers. We are regulated, etc. But we are entrepreneurs, and I think this is very core of our DNA, which gives us a lot of authenticity when obviously investing into funds, why funds want to partner with us, but also partnering with family offices and investors who are also very often entrepreneurs and made their money building traditional businesses. So this brings us a little bit to the end of the slides. We do have some more slides in the appendix, so depending on some of the questions that might get asked, we do have, since we are streaming on YouTube, LinkedIn, Riverside directly, we do have multiple different sources of questions coming in at this point. Yeah, but please, if you can, use the chat if you have access to it for questions. We had a question from Brian, who is from Earth First Food Ventures, an emerging VC fund focused on alternative proteins. So thank you, Brian, for your question. We actually invested in Nucleus Capital, Maximilian Bade. He's also invested in alternative protein companies, a great manager. We are very big fans of this space. So thank you for joining, Brian. And you asked a question about, first of all, sharing our analysis, our consensus that obviously right now we will have the best vintages, but also it's probably the hardest time to fundraise. And yes, we are in the same boat, obviously. We are also fundraising, we are investing in parallel. And I don't know, Marius, how was the fundraising for Rheingau founders? Was that easy?
It was never easy, I think.
Exactly.
In imagination, it's always easier than the reality. But Brian, to get back to your question, I mean, we obviously cannot invest into every emerging fund, but we are explicitly interested into emerging funds. So happy to review everything you have and see if it's a fit or not. But even if we as a AQVC are not able to invest because it doesn't fit our strategy, for example, or we are out of cash and need to raise first, there are other ways, and we, with our team, are in preparation of being able, because we know this problem and want to do something against it, to help the emerging funds or everyone who has a good product and needs more money with our tech platform. We are preparing it in these days. So it's always worth it, I think, to reach out, even though we, as mentioned, Stephan said it, have already an alternative protein sustainable food fund in our portfolio, but also at least even making introductions there may be of any help.
Yeah, I think, Marius, you know, we see ourselves like a fintech a little bit. Yeah, on one hand, we have our flagship fund of fund, which is our balance sheet product. This will grow over time. This is just, we are fundraising ourselves. We've invested in 9 funds. We're in double-digit millions now that we have in assets under management, and we do quarterly closings with a couple of million coming in every quarter, and these get bigger and bigger now. Yeah, and I think that means obviously we have a very clear investment strategy where we have already earmarked allocations. We want to get into certain funds, especially some of the top funds that we have access to. They're not really fundraising for 6 months, right? They find it easy to fundraise because the funds are small and they're oversubscribed because of the existing LP commitments. And so we always need to be ready when these funds call us and say, look, Stephan, you wanted to have an allocation, you got an allocation, let's go. Yeah, so this needs to go very, very fast. And with the emerging managers, sometimes we have a bit more time. But I think it's very important. What we have seen is that the emerging managers, over the last years, a lot of funds were started, and I would also say that a lot of funds shouldn't have been started, maybe, and a lot of tourists also entered the ecosystem. And I think now that it's harder, it also washes out some of the managers that shouldn't get funded. Yeah, and I think that's also it's a little bit Darwinistic and maybe brutal, but I do think it's part of the VC ecosystem where it's a bit of the survival of the fittest mentality. And one thing that I think is important there, with all the harshness of the reality, is that we try to pay attention to bringing more diversity to the ecosystem. Yeah, and I think this is important, that even if you don't have maybe an existing network into the LP ecosystem, if you have not been, great at wining and dining over your career, but you're a great investor, you have access to the best founders, you have a great thesis and experienced in alternative proteins, or we have seen other sectors like space tech, automotive, and a lot of these things, then that should not stop you from realizing your dream of building a firm. And I think this is where we want to be a part of, and then sometimes we can't invest, as Marius said, but that's where we want to be helpful. And we have helped multiple emerging managers get in front of great LPs, and also find for LPs again, finding great emerging managers along their allocation strategy. Yeah, and so this is where we see ourselves really as a partner, as an extension of not just our investors and their investment teams, but also a lot of GPs out there who are trying to find specific LPs for their next fund. All right. So Brian asked another question. What's our current AUM and what's the target for the evergreen structure? So again, we are now double-digit millions. We don't talk about actual AUMs on the webinar. The target size of our fund of fund is technically infinite. Yeah. Now, what does that mean, right? I think right now the threshold that we can legally manage is 500 million. Right now, we then need to get a full license from the BaFin, the German regulatory body. But Marius, maybe you can talk us about the process of also growing an AUM and the legal ramifications around that.
Yeah, obviously, it's also not only legal licenses or the financial authority who needs to say that more and yeah, be aware of what you do, and it's a decision of the BaFin, as Stephan said, but it's more also like what we are able to meaningfully deploy, right? So this is also very important. So I think midterm target size is 500, as Stephan said, and the long-term target is above 1 billion, right? So this is what we are aiming for, and what we are looking for. And I told you a bit about a potential listing and a potential needed volume, therefore, and there we are talking about 1 billion plus, right? Before it makes sense to make it fully liquid and even accessible for other segments of investors.
Yeah, I think the way we also look at it is a little bit in terms of recycling, because obviously when we make returns, some of it will be paid out to our investors in the form of dividends or share buyback, so they do get liquidity. And we explained earlier the diversification. So if we are investing and we have 50, 60 manager relations and we do every single one of their funds, that means we end up with around 600 to 900 underlying funds. Yeah. And so one of these funds will always be distributing. So at some point the portfolio is built and then you're basically distributing every year. And that's very attractive for investors because it means stable liquidity and stable returns. But it also means to us that some of that will also recycle into the next vintages. Yeah. And so right now we are aiming to recycle 70, 75%. This may change, right? So we may only recycle 50% or much lower over the years. But then we are also under allocation pressure. So if we believe that we can allocate around 400 to 500 million per year, anything above that will start to dilute our focus. Yeah, and I think that right now with the geographies of US, Europe, and Israel, with some emerging markets, I think that's already a very large market to cover. Where with 400, 500 million of allocations per year, I think this is still very, very focused. But anything above then starts to get much, much bigger. Again, counter arguing a little bit our focus and that story. Yeah. I hope this helped answer your question. Maybe leading on to that, Marius, a question on how much we invest per fund. Yeah. So we usually invest between 500K and 5 million, 6 million is the largest ticket we have done. But also that we want to then also increase over the years. what is sort of your point of view also and your experience on how much to allocate per fund?
Yeah, it's a very good question, and it's a kind of stupid answer as it's such a wide spread, right, between 500K and 5 million. But it really depends on stage of the GP, of the manager of the fund, emerging or established, and also what makes sense. So in a obviously bigger target or a bigger fund size, it makes less sense to invest only a small ticket. And with smaller funds, it's sometimes very important to not invest too big tickets, right? So I think the problem is in the answer that there is no way to go, right? So it's a very individual matter, and we decide fund by fund, really also not only about if we invest and how, but also about the amount we invest into this fund. So it's very individual for us.
Yeah, and I think also because we are evergreen, we want to be a long-term partner. Coming back to Marius's point, not just in building long-term investor relations with our investors and being an extension to their team, but also being a long-term partner for our funds. And this means also we want to grow with them, increase our allocations. Right now, we don't invest in, or we rarely invest. Maybe for some established managers, we do that in the first closes. But over time, we want to do this. And I think this is coming back to bringing more diversity into venture capital seeding and helping VC funds to get started. We really want to start backing them as early as possible right now because of the earliest stages of our own portfolio. We are not doing this, but we want to get there, right? And I think this is something that is also unique in the industry, that you have an LP with that kind of flexibility and deep understanding on how they can be helpful in the market. Normally, the seeding of funds and the large tickets in Europe, they come from the governments like the European Investment Fund or the KfW or BPI in France. And I think we want to do this more independently. And this is also important for the ecosystem. We don't take GP stakes because we just got that question, not with our flagship product. So we don't take GP stakes at this stage. So we have had this as an idea at some point, but right now we don't do this. So I think we're out of time. We started a little bit like 2-3 minutes later. There's still some questions coming in. But Marius, I don't know, do you have any final question that you want to pick? Otherwise, we'll wrap it up.
There are many coming in. I see just one coming. The average success rate of startups in VC portfolio is 10%. And why we do not connect the carry to the success rate to motivate VCs to increase the success rate of startups. Also a good question. And something we also had to learn as a fund of fund is we are a bit far away from the startup stage, right? So what we do now and what we as a fund of fund is our mission to find good managers who take the right decisions. So we are not able to motivate or to change the behavior of our VC fund manager. So we really need to, and this is mentioned, a learning, need to look for good managers who take the decisions industry-wise and also founder-wise and also strategy-wise. And therefore, yeah, we do not connect the carry to that.
Well, yeah, but I mean, carry is based on performance. So I do think there's a certain connection of carry to,
for sure.
Yeah, so to that. So, and there are usually hurdle rates in place, etc. But there are lots of questions still, so we have to wrap it up, unfortunately. But I think we can do a part 2 of maybe having an open forum more, where we skip the presentation. Maybe some people know it by now. And we dive directly into questions and share a little bit of the knowledge and have a more open and public discussion with some other LPs and VCs about the current challenges as well as opportunities that we are seeing in the ecosystem.
But as well, we are also happy to answer every questions offline, right? So
yes.
If your question was not answered, which should be actually the most ones, get back to us anytime.